Dear family of dreamers, beloved seekers of financial wisdom, I want to tell you something that might change the way you see money forever. There's a moment, a single moment, that separates those who build wealth from those who spend their entire lives chasing it. And that moment, it's quieter than you think. It's not dramatic. It's not flashy. It's not the moment you make your first million. It's the moment you stop being afraid and start being patient. Most people never reach that moment. They live their entire lives working, earning, spending, worrying, and they die having never understood the simple truth that was always right in front of them. But you're here, and that means something. Let me take you back to a small town in Nebraska, decades ago. There was a young man, 23 years old, working at a grocery store for $1.25 an hour. Every Friday he'd get his paycheck, the 50 out if he was lucky and by Sunday night it was gone. Rent, food, a drink with friends, maybe a movie. He wasn't irresponsible. He wasn't foolish. He was just living the way everyone around him was living. But one night, late at night, he couldn't sleep. He was lying in bed, staring at the ceiling, and he did something most people never do. He did the math. If he kept working at that grocery store, if he got the standard raises, if everything went perfectly, by the time he was 65, he'd have earned about $400 in his lifetime, and he'd have spent every penny of it. He'd have nothing to show for 2 years of work except memories and worn-out shoes. That realization, it didn't make him sad. It terrified him, because he understood, maybe for the first time in his life, that earning money and building wealth are two completely different things. Now, that young man, he started asking questions, not to financial advisors. He couldn't afford financial advisors, not to wealthy people. He didn't know any wealthy people. He asked questions to books, to newspapers, to annual reports he found at the library. And slowly, very slowly, he began to understand something. The wealthy don't work for money. They make money work for them. That sounds simple, doesn't it? Almost cliché. But think about what it really means. When you work for money, you trade your time, your energy, or your life for dollars. And when you stop working, the dollars stop coming. But when money works for you, when you own assets that generate income while you sleep, when you own pieces of businesses that earn profits 24 hours a day, you've broken the fundamental equation that keeps most people poor. That young man, he saved $40 from his next paycheck. It nearly killed him to do it. He ate ramen for a week. He walked to work instead of taking the bus. He said no to the movie, to the drink, to the things that made life feel a little less hard. But he saved $40. And then he did something that everyone told him was crazy. He bought stock, one share of a company. He didn't even fully understand what the company did, but he'd read that it paid dividends, that it had been in business for 50 years, that it was solid. That one share cost him $38. With fees, it was exactly $40. 3 months later, he received a check in the mail, 67 cents. 67 cents in dividends. And that 67 cents, it changed his life. Not because it was a lot of money. It wasn't. But because he didn't work for it. He owned something, and that something paid him. While he was sleeping, while he was working, while he was eating ramen and walking to work. That ownership, that tiny sliver of a business worked for him. And in that moment, he understood the first rule of investing. Test rule number 1, you must own things that grow in value while you sleep. Let me say that again, because this is so important. You must own things that grow in value while you sleep. Not things that make you feel rich. Not things that impress your neighbors. Not things that depreciate the moment you buy them. Things that grow. Assets, businesses. Pieces of companies that are serving customers, earning profits, creating value every single day, whether you're paying attention or not. This is the fundamental difference between poor thinking and wealthy thinking. Poor thinking says, I earned $3,000 this month, I can spend $3,000 this month. Wealthy thinking says, I earned $3,000 this month, I'm going to live on $2,500 and invest $500 in assets that will earn money for me forever. One person is trading time for money. The other person is building a money-generating machine. And over 10 years, 20 years, 30 years, the difference becomes almost incomprehensible. Let me tell you about 2 brothers. We'll call them Michael and David. They both started working at age 25. Both earned the same salary, about $45,000 a year. Michael spent what he earned. He wasn't extravagant. He just lived. Nice apartment, decent car, vacations once a year. He enjoyed his 20s and 30s. David lived differently. He lived in a smaller apartment, drove an older car, said no to most of the trips. And every single month, without fail, he invested $500, just $500, into dividend-paying stocks, into real estate investment trusts. Nothing fancy, nothing complicated, just consistent month after month, year after year. Michael had $8,000 in savings and about $15,000 in credit card debt. David had $97 in investments. By age 45, Michael was starting to panic. He had maybe $30,000 saved. Retirement felt impossible. David had $342,000, and it was growing faster than he could contribute to it, because the investments he made at 25 were now throwing off dividends, earning interest, compounding. By age 55, Michael was resigned to working until 70. Maybe longer. David retired. He had $1.1 million in investments, generating about $45,000 a year in passive income. Same starting point, same salary, different rules. Michael worked for money his entire life. David made money work for him. Toot now. I know what some of you are thinking. I don't have $500 a month to invest. I can barely pay my bills. I understand. I truly do. But here's what I need you to hear. It's not about the amount, it's about the habit. That young man who bought one share of stock for $40, he didn't have $500 a month either, but he had $40 once. And then he had $40 again the next month. And then $50 the month after that. The amount doesn't matter at the beginning. What matters is that you start. What matters is that you break the pattern of earning and spending, earning and spending, earning and spending. What matters is that you begin to see yourself not as a consumer of dollars, but as a builder of assets. Let me share something with you that nobody wants to admit. The biggest barrier to building wealth isn't lack of money, it's lack of patience. We live in a world of instant gratification, instant coffee, instant streaming, instant delivery. We've been trained to expect instant results. And so when someone starts investing, when they put $100,000 into the stock market and 3 months later it's worth a 980, they panic. This isn't working. Investing is a scam. The market is rigged. And they sell. They take their 980 and they go back to their old habits, earning and spending, earning and spending. And they never understand that they were 3 months into a journey that takes decades. They were trying to pick fruit from a tree they planted last week. Here's what I've learned watching thousands of investors over many decades. The people who get rich from investing, the ones who actually build meaningful wealth, they're not the smartest people. They're not the ones with the best stock picks. They're not the ones who can predict the market. They're the ones who can sit still. They're the ones who can watch their portfolio drop 30% in a crash and not sell. They're the ones who can see a stock they own go down 15% and buy more. They're the ones who understand that wealth is built in decades, not days. This is rule number 2. This is rule number 2. Time is more powerful than timing. You see, let me tell you about a woman named Sarah. Sarah started investing when she was 32. She wasn't wealthy. She was a school teacher making $38 a year. But she read a book, and that book explained something simple. If you invest $200 a month starting at age 32, and you earn an average return of 8% per year, which is slightly below the historical average of the stock market, by age 67, you'll have about $428,000. But if you wait until you're 42 to start just 10 years later, investing that same $200 a month at that same 8% return, you'll have about $186,000. 10 years of waiting cost her $242,000, not because the investments were different, not because the returns were different, because time is the secret ingredient. Time allows compound interest to work its magic, and compound interest, when you really understand it, is the closest thing to magic that exists in the world of money. Albert Einstein supposedly called compound interest the 8th wonder of the world. And he was right. Here's why when you invest $100 and it earns 8% in the first year, you have $180. In the second year, you don't earn 8% on $100 and you earn 8% on $180. You're earning interest on your interest. That seems small at first, trivial almost. But by year 1,000 has become 2,159. By year 20, 4,661. By year 10, that was 63. You invested $1,000 once 30 years ago, and now it's worth over $10,000. You didn't do anything. You didn't work for it. You didn't watch it every day. You just waited. You gave time permission to work. But here's where most people fail. They can't wait. Year 3 comes and their $100,000 is only worth $260. This is taking forever, they think. I'm only up $260 in 3 years. That's nothing. So they pull it out. They spend it. They give up. And they never get to year 10 or year 20 or year 30. They never experience the exponential growth that happens when you let time do the heavy lifting. Sarah understood this. Sarah had a secret that kept her disciplined. She had a picture on her refrigerator, a picture of herself but aged, wrinkled, gray-haired, and written on that picture in her own handwriting, "Thank you for investing in me." Every time she wanted to skip a month, every time she wanted to use that $200 for something else, she looked at that picture. And she remembered she wasn't investing for today. She was investing for the woman in that picture. The woman who would be 70 years old someday, who would need that money, who was counting on the 32-year-old version of herself to make good decisions. This is the mindset shift that changes everything. When you're young, when you're struggling, when you're living paycheck to paycheck, it's easy to think that future you is some abstract concept. But future you is real. Future you is going to exist. Future you is going to have needs, desires, medical bills, grandchildren they want to help. And future you is going to either thank you or resent you based on the decisions you make today. Every dollar you invest today is a gift to your future self. Every dollar you spend frivolously today is a theft from your future self. That's not judgment. That's just mathematics. Let me share one more story before we move to rule number 3. There was a man, an ordinary man, who worked as a janitor his entire life. He never earned more than $25,000 a year. He lived in a small apartment, drove an old car, wore the same coat for 20 years. People felt sorry for him. When he died at age 92, his estate went through probate, and the lawyers discovered something shocking. This janitor, this man everyone pitied, had died with $8 million in investments. $8 million from a man who never earned more than $20,000 a year. How? He invested. From his very first paycheck, he invested 20% of everything he earned. He bought dividend-paying stocks, blue chip companies, boring companies, companies that sold soap and cereal and toothpaste. And he never sold. For 70 years, through wars and depressions and market crashes and booms, he held those stocks. He collected the dividends. He reinvested them. He bought more shares. And time, patient, relentless, unstoppable time, turned his modest savings into generational wealth. When they found his papers, his investment statements, they noticed something. During the 2008 financial crisis, when the market crashed 50%, when everyone was panicking and selling, this 90-year-old janitor, he bought more. He didn't panic. He didn't sell. He understood something that most professional investors never learn. The best time to invest is when everyone else is terrified. The janitor's secret wasn't complicated. It wasn't a special strategy. It wasn't insider information. It wasn't luck. It was something far simpler and far more profound. He understood that the market, this vast, chaotic system of billions of transactions, has one predictable characteristic. It rewards those who show up every single day. Not the ones who show up when it's convenient. Not the ones who show up when the market is soaring. The ones who show up consistently, regardless of what's happening. Let me tell you what happens to most people when they start investing. They start with enthusiasm. They open an account. They buy their first stock or fund. They check it every day. First week, they're up 2%. They feel brilliant. Second week, they're down 3%. They feel nervous. Third week, they're up 1%. They feel confused. By the second month, they're exhausted from the emotional roller coaster. And when the market inevitably has a bad quarter, when their $1,000 becomes $850, they quit. Not because they lost faith in investing, but because they were investing emotionally instead of systematically. Let me ask you something. When you get paid, when that paycheck hits your account, do you debate whether or not to pay your rent? Do you sit there and think, well, rent is expensive this month. Maybe I'll skip it. Maybe I'll wait until next month when I feel like it. Of course not. Rent is automatic. It's non-negotiable. It's a system. So why do so many people treat investing like an optional activity? I'll invest when I have extra money. I'll invest when the market looks good. I'll invest when I understand it better. These are the words of people who will never build wealth, because wealth isn't built in the moments you feel like it. Wealth is built in the system you create that works, whether you feel like it or not. This brings us to rule number 3. And this is the one that most people violate, even when they think they're being smart. Rule number 3, invest automatically, consistently, and without emotion. Let me break this down, because each part is critical. Ours automatically means you don't think about it. You don't decide each month. You don't debate. You set up a system, a transfer from your checking account to your investment account. That happens on the same day every month without you touching it. Consistently means same amount, same schedule every single time. Not 500 one month and others the next. Not hundreds, thousand when you're feeling flush and nothing when you're feeling tight. The same amount, like clockwork. Without emotion means you don't check the market before you invest. You don't wait for dips. You don't try to time it. You invest on your schedule, whether the market is up, down, or sideways. This strategy has a name. It's called dollar cost averaging, and it's the most powerful wealth building tool available to ordinary people. Here's why it works. When you invest the same amount every month, regardless of market conditions, you automatically buy more shares when prices are low and fewer shares when prices are high. You're doing exactly what every expert tells you to do: buy low, sell high, without even trying. Let me show you. Imagine you invest $500 every month in an index fund. In January, the fund costs $50 per share. Your $500 buys you 10 shares. In February, the market drops. The fund costs the $40 per share. Your $500 buys you 12.5 shares. The market recovers. The fund costs $55 per share. Your $500 buys you 9 shares. Over 3 months, you invested $500. You now own 31.5 shares. Your average cost per share of $47.62. But if you'd tried to time the market, if you'd waited for the right moment, if you'd gotten scared in February when prices dropped, you'd own fewer shares at a higher average cost. Dollar cost averaging removes the emotion, removes the guesswork, removes the fear. You just show up every month, same time, same amount, and you let mathematics do the rest. 2 now. I know some of you are thinking, but what if I start investing right before a crash? What if I invest $10 and the market drops 40%? A valid question. Let me tell you about a man named Bob. Bob had the worst market timing in history, literally the worst. Bob started investing in 1973, right before a 48% market crash. He invested $6, and 6 months later his investment was worth $320. Most people would have quit, would have sworn off investing forever. But Bob kept going. He kept investing $500 every month. In 1987, right before Black Monday, the worst single-day crash in history, tens of thousands of the market dropped 22% in one day. Bob's done 10,000 became 700, 800 overnight. Again, most people would have quit. Bob kept going. In 2000, right before the dot-com bubble burst, Bob invested 20,000. The market dropped 49% over the next 2 years. Bob's 20,000 became the 10th 200. And again, Bob kept going. In 2007, right before the financial crisis, Bob invested 30,000. The market dropped 57% over the next 18 months. Bob's 30,000 became 12,900. You see the pattern. Bob had the worst luck in the history of investing. He invested large sums at the exact worst possible times. But Bob kept his system. He never sold. He kept investing $500 every single month, through every crash, through every panic, through every moment when the experts were screaming to get out. By 2013, when Bob retired at age 65, his portfolio was worth $1.1 million. Despite investing at the worst possible times, despite seeing his investments get cut in half multiple times, despite doing everything wrong, according to the market timers, Bob became a millionaire because Bob understood rule number 3. Systems beat emotions every single time. Let me tell you what happens in real life when the market crashes. I've seen this over and over. Decade after decade, the market drops 20%. The news is screaming. Everyone is panicking. Your friends are selling. Your family is worried. And you're checking your portfolio every hour. You watch your 50,000 become to $40, and your stomach is in knots. You can't sleep. You're convinced this time is different, that the market won't recover, that you should sell now before it gets worse. This is the moment. This is the moment that determines your financial future. The people who sell, who lock in their losses, who swear they'll get back in when things calm down, They never do. They sell at the bottom. They sit in cash while the market recovers. And when they finally feel safe enough to invest again, prices are higher than when they sold. They bought high, sold low, lost money, lost faith. But the people who have a system, who have automatic investments set up, who aren't checking their accounts every day, they don't even notice. Or if they notice, they smile. Because their automatic 500 investment just bought 25% more shares than it did last month. The crash isn't destroying them. It's offering them a sale. Pay to, I want to share something personal with you. In 2008, during the financial crisis, I watched people lose everything. Not because the market crashed. The market always crashes eventually. They lost everything because they didn't have a system. They were investing based on feelings, based on hunches, based on what their brother-in-law said at Thanksgiving. When the market was soaring in 2006 and 2007, they were buying excited, confident. When the market crashed in 2008, terrified, convinced it was over. They did exactly the opposite of what they should have done. But I also watched other people, quieter people, people with systems. They kept investing. Their automatic $1,000 a month kept going into their 41, kept buying index funds, kept accumulating shares while everyone else was running for the exits. By 2013, when the market had fully recovered, the panic sellers were still sitting in cash, having missed the entire recovery. The systematic investors had doubled their money. Same market, same crash. Completely different outcomes, the difference. One group had emotions, the other group had systems. So let me give you a practical framework, something you can implement today. First, decide on an amount you can invest every single month without fail. Not an aspirational amount. Not, I'll invest $1,000 when things are good. A guaranteed amount. An amount so reasonable that you'll never have an excuse to skip it. Maybe it's 50 ed. Maybe it's 200. Maybe it's 500. The amount doesn't matter. What matters is that it's consistent and automatic. Second, set up automatic transfers from your checking account to your investment account. The day after you get paid, before you have time to spend it on anything else, that money moves. You never touch it. You never debate it. It just happens. Third, invest in broad, diversified, low-cost index funds, not individual stocks, not crypto, not the hot tip from your coworker. Index funds, boring, reliable, proven index funds that track the entire market. Something like an S&P 500 index fund or a total market index fund. These funds own hundreds or thousands of companies. When you buy one share, you own a piece of the entire economy. You're not betting on one company. You're betting on human progress, on innovation, on the fact that over time businesses create value, and that value flows to owners. Fourth, and this is critical, never look at your account. I'm serious. Check it once a quarter maybe, just to make sure the automatic investments are going through. But don't check it daily. Don't check it when the news is scary. Don't torture yourself watching the numbers go up and down. Because here's what happens when you check constantly. You see red. You panic. You start thinking about selling. Or you see green, you get excited. You start thinking about buying more with money you don't have. Either way, you're making emotional decisions. And emotional decisions in investing are almost always wrong. Let me tell you about a study, one of the most important studies in investment history. Fidelity, the big investment company, did an analysis. They wanted to know which of their accounts had the best performance over a 20-year period. The top performers, the accounts that beat everything, that outperformed hedge funds and professional managers and sophisticated traders. Who do you think they belonged to? Financial experts, former Wall Street traders, people with MBAs. No, the best performing accounts belonged to people who forgot they had them, dead people, and people who forgot their passwords. These accounts were set up decades ago with automatic investments and then never touched, never traded, never adjusted, never panicked and sold. Just automatic deposits, year after year, completely ignored. And they crushed the active traders. They crushed the people who were constantly trying to optimize. Because doing nothing, when you have the right system, is the most powerful strategy in investing. And now, let me address the fear I know some of you are feeling. What if I start now and the market crashes tomorrow? Here's the truth. The market will crash, will. I don't know when. Nobody knows when, but it will happen. maybe next month, maybe in 5 years, maybe in 10, and when it does, your portfolio will drop significantly. You'll see red numbers, big red numbers, and that's okay, because if you're following rule number 3, if you have automatic investments set up, if you're investing consistently without emotion, that crash is your friend. It's offering you a discount. Your 500 that used to buy 10 shares, now it buys 15 shares. You're accumulating ownership in real businesses at sale prices. The only people hurt by crashes are the ones who sell during them. Let me give you a mental framework that might help. Imagine you go to the grocery store every week. 1 week, milk costs $4 a gallon. The next week, milk costs $3 a gallon. Do you panic? Do you refuse to buy milk because the price dropped? Do you worry that milk is worthless now? Of course not. You're happy you buy more milk, it's on sale. But when stocks drop 20%, people panic and sell. They do the exact opposite of what they do with milk. They see a sale and they run away. This is the insanity of emotional investing. You want to buy assets when they're cheap, not when they're expensive. You want to accumulate shares during crashes, not during bubbles. But to do that, you need to remove emotion from the equation. You need a system that invests whether you're scared or confident, whether the market is soaring or crashing. Here's what I want you to understand at a deep level. Wealth is not built by people who make brilliant trades. Wealth is built by people who make consistent deposits. The janitor with $8 million didn't pick winning stocks. He picked a system, and he never broke it. Sarah, the school teacher, didn't time the market. She showed up with 200 every single month for 35 years. Bob, with the worst timing in history, didn't wait for the perfect moment. He invested on his schedule and let time heal all wounds. These people, these ordinary people, became wealthy not through genius, but through discipline, through systems that worked when they were paying attention and when they weren't, through the understanding that consistency beats intelligence in the investing game. Let me share one more story before we move to part 3. There was a woman named Grace. Grace was a nurse. She worked night shifts, made about $52 a year. When she was 28, she attended a financial seminar. The speaker said something that stuck with her. If you can't afford to invest 15% of your income, you can't afford your lifestyle. That hit Grace hard. She was living paycheck to paycheck, barely making the idea of investing 15%, about $650 a month, seemed impossible. But that night, Grace did something radical. She didn't try to earn more money. She didn't look for side hustles. She looked at her expenses. And she realized she was spending $300 a month on a car she didn't need. She was spending $200 a month eating out. She was spending $150 a month on cable and subscriptions she barely used. She was spending money on a lifestyle that made her look comfortable while keeping her financially fragile. So Grace made a decision. She sold the fancy car, bought a reliable used car for cash. She cooked at home, packed lunches. She canceled everything except internet. And suddenly she had $650 a month. She set up automatic investments into a target date retirement fund. $650 every month, on the 5th, like clockwork. For the first year, she hated it. She missed the restaurant meals. She missed the car. She felt like she was sacrificing. But by year 2, something shifted. She stopped missing those things. She started feeling powerful. Because every month, she'd log in and see her balance growing. She'd see the shares accumulating. She'd see the dividends reinvesting. And she realized those restaurant meals she used to buy, they were gone forever. Consumed, forgotten. But these investments, these were permanent. These would be with her forever, growing, compounding, working. She traded temporary pleasure for permanent power. To by age 45, 17 years later, Grace had invested $132,600. Her portfolio was worth $287,000. She'd more than doubled her money. But more importantly, she'd changed her relationship with money. She no longer felt anxious about her future. She no longer felt trapped by her job. She had options. She had security. She had peace. And it all started the day she decided to prioritize her future self over her present comfort. You know what the hardest part of investing is. It's not picking the right stocks. It's not understanding financial statements. It's not predicting the market. The hardest part, the part that stops most people before they even begin, is simply starting. Because starting requires you to admit something uncomfortable. It requires you to admit that your current path, The path you've been on isn't taking you where you want to go. And that admission, that moment of honest self-reflection, it hurts. I've met thousands of people over the decades who tell me they want to invest. I'm going to start next month. I'm going to start after I pay off this credit card. I'm going to start when I understand it better. I'm going to start when I have more money. And you know what happens? Next month comes and they don't start. The credit card gets paid off and they don't start. They read another book and they still don't start. They get a raise and they spend it instead of investing it. Because starting isn't about knowledge. Starting isn't about having enough money. Starting is about making a decision right now, in this moment, that your future matters more than your comfort. Let me tell you about a conversation I had with a young man, maybe 30 years old. He came up to me after a talk I gave. He was earnest, sincere. I want to start investing, he said, but I only have $100 a month I can afford to invest. Is that even worth it? I looked at him and I asked him a question. If you invest $100 a month starting today at age 30 and you earn an average return of 8% per year, do you know what you'll have at age 65? He shook his head. About $229,000. His eyes went wide. But, I continued, if you wait 10 years, if you start at age 40 instead of 30, investing that same $100 a month at that same 8% return, you'll have about a $91,000. I let that sink in. 10 years of waiting will cost you $138,000. That's not the cost of the money you didn't invest. That's the cost of the compound growth you missed. So is $100 a month worth it? It's worth $138,000. This is what people don't understand about small amounts. They think, what difference does 50 make? What difference does 100 make? The difference is everything. Because investing isn't about the amount you start with. It's about the time you give that amount to grow. A small amount over a long time beats a large amount over a short time every single time. So let me give you the exact steps right now to start investing today, not tomorrow, not next month, today. Step 1, open a brokerage account. This is easier than you think. Companies like Vanguard, Fidelity, Schwab, they make this incredibly simple. You go to their website, you click open an account, you fill out some basic information, name, address, social security number, bank account information. It takes about 15 minutes. You don't need a lot of money. Most of these companies have no minimum to open an account. You don't need to talk to anyone. You don't need to feel embarrassed about being a beginner. You just fill out the form. And suddenly, you have an investment account. That's it. That's step 1. Step 2, set up automatic transfers. This is the most important step, because if you rely on yourself to manually transfer money each month, you won't do it consistently. Life will get in the way. Expenses will come up. You'll have a good reason to skip a month. But if it's automatic, if the money moves from your checking account to your investment account on the same day every month without you thinking about it, it just happens. You can set this up in about 5 minutes. You tell your brokerage, transfer $100 from my bank account on the first of every month. And they do it forever until you tell them to stop. This one step, this automation, is worth more than any investment advice you'll ever receive because it removes willpower from the equation. It removes decision fatigue. It removes the possibility of failure. 2, step 3, choose your investment. This is where people get paralyzed. They think they need to pick the perfect stock, the perfect fund, the perfect strategy. They spend months researching, watching videos, reading articles, and they never invest. So let me make this simple for you. If you're a beginner, if you don't know anything about investing, if you want something that works without requiring you to become an expert, buy a total market index fund. That's it, something like VTSAX at Vanguard or SKX at Fidelity or SWSX at Schwab. These funds own the entire U.S. stock market. When you buy one share, you own a tiny piece of thousands of companies. Apple, Microsoft, Johnson & Johnson, Walmart, Tesla. Small companies you've never heard of. You're not betting on one company succeeding. You're betting that the American economy, that capitalism itself, will continue to grow over time. And historically, over any 20-year period, that bet has always paid off. Not every year, not every decade, but over the long term, consistently, the market goes up. Some of you might be thinking, but what about individual stocks? What about finding the next Amazon, the next Apple? Let me tell you something. I've spent my entire life analyzing businesses, understanding competitive advantages, identifying great companies. And even with all that experience, all that knowledge, all those resources, even I can't consistently pick individual stocks that beat a simple index fund. Because the index fund owns everything. When Amazon succeeds, the index owns it. When the next great company emerges, the index will own it. You don't have to find it. You don't have to pick it. You don't have to be right. You just have to own the whole market and let the winners pull you forward. To a step 4, ignore it, Das. This is the hardest step for most people. You've set up your account. You've automated your investments. You've chosen your fund. Now, walk away. Don't check it every day. Don't refresh your app at lunch. Don't panic when you see red. Don't get excited when you see green. Just live your life. Let the system work. Because here's what I've learned. The more you watch your investments, the worse you do. Every study confirms this. The people who check their portfolios constantly make emotional decisions. They see a 10% drop, they panic and sell. They see a 15% gain. They get greedy and buy more with money they shouldn't invest. They turn investing, which should be boring and systematic, into gambling, which is exciting and destructive. Let me tell you about 2 investors. Both started with 10,000. Both invested in the exact same index fund. Investor checked his account every day. Sometimes multiple times a day he read the news. He worried about crashes. He sold when things looked scary. He bought back in when things felt safe. Investor B set up his investment and forgot about it. He checked it once a year, just to make sure everything was working. He never sold. He never tried to time anything. After 20 years, Investor A had turned his $10,000 into $31,000. Not bad. He tripled his money. Investor B had turned his $10,000 into $67,000. Same starting point, same investment, same time period. But Investor B made twice as much. Why? Because he didn't get in his own way. He didn't sell during the 2008 crash. He didn't panic during the 2020 COVID drop. He just stayed invested. And staying invested, doing nothing, beat the active approach by more than 100%. This is the paradox of investing. The less you do, the better you perform. The more you try, the more you lose. Because the market, over long periods, rewards patience and punishes activity. Every trade costs you money in fees and taxes. Every emotional decision, buying high when you're excited, selling low when you're scared, costs you returns. The people who do best are the ones who set up a system and then walk away, who trust the process instead of trying to outsmart it. And now let me address some fears I know you might have. Fear number 1. What if I invest and the market crashes? Then you keep investing. Remember Bob, the man with the worst timing in history. He invested right before every major crash and still became a millionaire because he didn't panic, he didn't sell. He kept his system. A crash is not the end of your investment journey. A crash is a test. It's testing whether you have a system or just enthusiasm. Enthusiasm quits during crashes. Systems keep going. Tubu's fear number 2. What if I need the money? That's why you have an emergency fund first. Before you invest a single dollar, you need 3 to 6 months of living expenses in a regular savings account. That money is for emergencies, for job loss, for medical bills, for life. You never invest money you might need in the next 5 years. Investing is for money you won't touch for decades. If you don't have that emergency fund yet, build it first. $50 a month into savings until you have 3 months of expenses. Then and only then start investing. Because if you invest money you might need soon, you'll be forced to sell at the worst possible time. And that defeats the entire purpose. Fear number 3. I don't know enough. I need to learn more first. No, you don't. You need to know 3 things. 1, invest in low-cost index funds that track the total market. 2, invest the same amount every month automatically. 3, don't sell for at least 20 years. That's it. That's all you need to know. Everything else is noise. Every complicated strategy, every hot tip, every market prediction, it's all noise designed to make you feel like investing is harder than it is. But it's not hard, it's simple. It's just not easy, because it requires patience. Let me tell you about the most powerful force in wealth building. It's not intelligence. It's not education. It's not even money. It's the decision to start. Every wealthy person I've ever known, Every person who built meaningful financial security, they all had one thing in common. They started, not when conditions were perfect, not when they felt ready, not when they had it all figured out. They started and they figured it out along the way. There was a young woman, 24 years old, working retail for minimum wage. She heard about investing. She wanted to start, but she was scared. She had 37 in her bank account after paying bills. She thought, I can't invest with 37. That's not enough. I need to wait until I have more. But then she realized something. If she waited until she had enough, she'd never start. There would always be a reason to wait, a bill, an expense, a want. So she did something radical. She invested $20. She bought a fractional share of an index fund. And the next month she invested $20 again. And the next month, for 2 years, she invested $20 a month. That's $480 total. Then she got a better job. Started investing $100, then $500. By age 35, 11 years later, she had $87,000 in investments. Not because she was rich, not because she had some advantage, because she started with $20 dough when everyone else was waiting to have enough. You see, the secret isn't having money. The secret is starting before you feel ready, because you'll never feel ready. There will always be a reason to wait, always a better time, always something more important. But the people who build wealth, they don't wait for permission. They don't wait for perfect conditions. They start with whatever they have, wherever they are, and they trust that starting, even small, is infinitely better than waiting for someday. So let me ask you a question, and I want you to really think about this. What would your life look like 20 years from now if you started today, if you invested $100 a month or $200 now, or whatever you can afford, and you never stopped, never sold during crashes, never tried to time the market, just kept showing up month after month, year after year? What would that person, that future version of you, what would their life look like? Would they have financial stress or financial peace? Would they be trapped in a job they hate or free to make choices? Would they be worried about retirement or confident in their future? The answers to those questions, they're being determined right now by the decision you make today. And now let me ask you the opposite question. What would your life look like 20 years from now if you don't start? If you keep waiting for the perfect time? If you keep telling yourself you'll start next month? If you keep spending everything you earn? What does that future look like? I've seen that future. I've met those people. They're 70 years old, still working, because they can't afford to retire. They're dependent on Social Security, $100, $800 a month, trying to survive on that. They're stressed, anxious, full of regret. Not because they weren't smart, not because they didn't work hard, but because they never started investing. They waited for someday, and someday never came. Here's what I want you to understand. This isn't about being rich. This isn't about having a yacht or a mansion or impressing anyone. This is about freedom. The freedom to say no to a job that's destroying your health. The freedom to help your children when they need it. The freedom to retire with dignity. The freedom to make choices based on what you want, not what you can afford. That freedom, it doesn't come from winning the lottery. It doesn't come from a big inheritance. It doesn't come from getting lucky. It comes from making a decision right now to start building it. $1 at a time, 1 month at a time, 1 year at a time. Let me leave you with this. The 3 rules we've covered today are: Rule 1, own things that grow in value while you sleep, is Rule 2. Time is more powerful than timing. Interfess, Rule 3, invest automatically, consistently, and without emotion, as these aren't complicated. A child could understand them. But most adults, they violate these rules every single day. They spend instead of owning. They try to time the market instead of giving time to work. They invest emotionally instead of systematically, and they wonder why they never build wealth. But you have the knowledge now. You understand the rules. You've heard the stories. You know what works. The only question left is, will you do it? Will you open that account today? Will you set up that automatic transfer this week? Will you start right now building the future you deserve? Or will you close this video, tell yourself you'll do it later, and let another month slip by? I can't make that decision for you. No one can. But I can tell you this: every wealthy person I've ever known, Every person who achieved financial freedom, they all remember the day they started. Not because it was easy, not because they had a lot of money, but because it was the day everything changed. The day they stopped being a consumer and became an owner. The day they stopped working only for money and made money start working for them. The day they stopped waiting for someday and made today their someday.